Hi, I want to give you guys a quick explanation for question one. This is the one that we had on July 18th during the summer of 2011. This is the one where you own a small nightclub in the Portland area. Now the first transaction we have on there is that your club needs space control, the ability to close off and open rooms to maintain the right density of people throughout the club. New walls and entryways will cost, but you do it out of retained earnings. So what we're doing right here is we're transferring one kind of assets, cash, and turning it into basically a bunch of walls and stuff like that. So what you should see is on your balance sheet a decrease in one kind of asset, which is cash, an increase in the other kind of asset, which is those fixed assets. Those are the walls and things like that. So your balance sheet balances out between the two of those, and you shouldn't see any kind of changes in liabilities or owner equity. Now, because cash is on one side of the transaction, you know there's going to be a flow over to the cash flow statement. So you should be looking at is that you've got investments going on, and so you have a decrease in cash over in the investment section on the cash flow statement. So that's a full explanation of what you should see for question number one. Question number two is you hire a group of attractive people to dance at the club from 11 to 3:30. So basically you're looking at an expense. And so you go over the income statement and you should see an increase in operating expenses over there. This is question number two. And anytime you got something that happens on the income statement, it'll have an impact some way on net income. That's the thing down at the bottom. Now, operating expenses go up, net income goes down, cash from operations goes down, and that's the feed over that takes place over on to the cash flow statement. Question number three is you get a delivery of Red Bull and an invoice for the same. Basically what you're doing here is you get an increase in one kind of assets, that's inventory. At the same time you get an increase in liabilities, and that's something that balances out the income statement, the balance sheet for you. So the increase in assets is balanced off by the increase in liabilities. That works just fine. Now the feed over in the cash flow statement is a little bit tricky, because really what's going on is you got a decrease in cash from investments. That's the Red Bull coming in. You also have an increase in cash from finance. That's the invoice that's there. And so it balances each other out too. Not essential, it's just that there was no net cash changing hands, so you knew that you had to have this up and down thing. And that's the way it should work out on the cash flow statement. So that was one of those tricky ones, so it ended up being in 4 spots. Question number 4, balancer wants to borrow $500 till Friday. You'd lend him money out of petty cash. In this case, what you have is a decrease in one kind of assets, which is cash, a increase in another kind of assets, which is basically a note payable or account payable, something like that. It's a short-term liability, something that somebody else owes you, so it's one of your assets. Main point is it balances out right there in the assets. There's no liabilities or anything to worry about. Having it feed over to the cash flow statement is a little bit tricky. What you have to remember is the finance section's for borrowing and lending, and you lent money. So you have a decrease in cash from finance, and that'll be over on the finance section. When he pays you back, that'll crank up a little bit over there, and you'll have a source of cash. You bring in a new partner. This is question number 5. He bought in with $500,000 cash. So what you're seeing here is an increase in cash. That's a $50,000. You have an increase in owner equity, and that's how it's balanced out. So your assets are always equal to liabilities plus owner equity. And that's the end of the balance sheet. The feedback that happens into the cash flow statement is that there's an increase in cash, and the way that you handle just about everything that's in liabilities and owner equity is over in the finance. So you see an increase in cash from finance. And that's how you have your new partner come in. 6, there have been too many complaints to the city. You have to hire additional security, increase in operating expenses. This one is effectively the same as question 2. It's just an increase in expenses. That feeds back into cash from operations, so there's a decrease over there. Number 7, you sell off part of an old sound system and bar glasses to a new club. So you're taking one kind of assets, those are your fixed assets, decreasing those, getting cash to come into the system, and so you got a transaction that balances out on the balance sheet just in the asset section. You should also see an increase in cash from investments over in the cash flow statement. That's how it feeds back. Now if you're checking this kind of stuff up, this is the opposite that you have of question 1. So question 1 was something that took cash and turned it into a fixed. This is something that takes fixed and turns it into a cash. And so the cash flow effects in the investment section should be the opposite of each other, which is kind of nice. The last one is the advertisement that Willamette give you for free works. People are lined up around the corner. Increase in revenues, increases net income, increases net income, increases cash from operations, and that's the final feedback that goes through. Again, these are the answers to essential question number 1 that we did one of them on July 18th in the summer of 2011. Thank you.